It's the trillion-dollar problem facing our country. Can lending startup Earnest reinvent the lending landscape and make a dent in our debt crisis?
We are always on the lookout here on Mad Money for privately held companies that are upending their respective industries, either with new products or innovative practices. That's why we go off the tape and on the hunt. Because sooner or later, these startups are going to impact the publicly traded companies that you can invest in. Take Earnest. That's the online lender that specializes in student loan refinancing and personal loans for everything from buying a home to paying for a wedding reception. With Earnest, the whole process of borrowing money can be done online, and they'll charge you lower interest rates than conventional banks. How can they get away with that? Simple. Earnest has a hyper-personalized underwriting process where they lend you money. They look at a lot more than just your credit score, and their proprietary software helps them figure out whether or not you're a good credit risk. Now, the company's been around for 3 years, and they just last month crossed the billion-dollar loan mark. I think this is a great example of how the online lending space is dragging the financial sector kicking and screaming into the 21st century. So let's sit down with Louis Burrell. He is the co-founder and CEO of Earnest. Hear more about his company and what sets them apart from both traditional banks and the plethora of online lenders that have popped up in recent years. Mr. Burrell, welcome to Mad Money. Good to see you, sir. Have a seat.
Hi, Jim.
Thank you. All right, now we've had a couple of the online lenders on, and candidly, they haven't done that well. I would say that they either had trouble finding investors to buy their loans or they were sloppy underwriters. How do we distinguish that from you?
Yeah, I think the first part is what you were just talking about, sloppy underwriting.
Right.
So at Earnest, what we're doing is the most thorough underwriting of anybody in the business, offline, online. And the way we do that is we're actually looking at the full financial profile of all the individuals. So we're looking at their bank accounts, we're looking at their past debts, but we're also diving into their asset accounts. And that's something that no one else is doing, and we're doing it by connecting directly to their online financial accounts.
Now, I would presume that a JP Morgan or Wells Fargo could do this if they wanted to.
Yeah, I mean, I think that, when you talk about could've, would've, should've, like lots of companies could try to do what other more innovative companies are doing, but I think ultimately, we're totally vertically integrated, and we rethought from first principles, how would you assess someone? So this happened to me. I was going to graduate school, and it didn't really make any sense to me that you weren't looking at all my past job history, and you weren't looking at all of the savings I had right at that moment in time. And if you think about the traditional system kind of had built up this reliance on credit bureaus.
Right.
And credit bureaus are just missing cash flow.
You're talking about like a FICO score.
Exactly.
That is, as far as you're concerned, that's almost an abstraction versus what you're working with.
It's a subset.
It's
right?
a subset.
So,
fair
like,
enough.
if you think about a balance sheet, like the balance sheet of any consumer, the credit score, the FICO is just a summation of the lines on someone's credit bureau report, but it's got lagging data, and it's totally missing the other side of the balance sheet, which is the asset side, and then it's totally missing the income statement.
Excellent. Now, people have used you. How much money have they saved?
Yeah, so the average borrower saves just under $22,000, and so for the $1 billion of loans that we've done just over, it's $300 million in aggregate that we've saved our clients.
And how much money is Earnest able to make? Presumably, some of these banks would say, well, look, they must be not making, they're taking a risk by not making enough. We have to make up enough so that we don't, if we lose, we're still okay.
Yeah, I mean, so we charge very low interest rate. Overall, our interest rates are about 5%. But what we're doing is we're really good at, one, reducing our costs using software and automation, as well as really assessing the risk. And so, over the whole life of the business for $1 billion of our student loan refinancing, we've never had a loan default outside of the result of one of our borrowers passing away.
Never. Never.
Never, yeah. None of our student loans.
That's extraordinary. Wow. Now, a lot in the news about this Wells Fargo. Is that an opportunity for you? Do you think people say, you know what, if the so-called greatest banks in the world are doing this stuff, I am willing to venture out and go to a bank that is new, that I trust more than the old? Yeah,
I mean, I think all financial services, in the whole history of financial services, is built on trust. But I think, and even in many ways, financial services has been built on innovation. But I think when you look at some of the larger incumbents, like this Wells Fargo example, that's kind of in a chase for revenue, in a chase for earnings, they have seemed to have lost their way. And this is I think just another example. But when we started this company 3 years ago, we knew that there was a huge opportunity to really start over from scratch and build something better.
Last question. I find it intriguing. You keep the loan.
Yeah.
So if I get in trouble, I actually can talk to someone.
Exactly. We originate all the loans on our balance sheet. Now, we do use the securitization market to finance our balance sheet, but then we do all of the loan servicing for the life of the loan. And so that's something that's also unique. Like I said, we're totally vertically integrated.
Right.
We have a mobile app, we have our web dashboard, and we've innovated a lot of features. So like one of the features we have on the servicing side is the skip-a-pay feature. So if you're in good standing and you'd like to take a month off, you can just skip a pay. And what's really interesting is, so now Goldman Sachs just launched the new Marcus.
Right.
And that's one of the features of ours that they've emulated. And so,
excellent. Well, anyway, I think it's very, very creative and a great solution for a lot of people. Thank you so much for coming on. That's Louis Burley's co-founder and CEO of Earnest, and it's spelled E-A-R-N-E-S-T. Thank you.
Thank you.
Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.